Hello viewers, welcome back to our YouTube channel, and today we are going to continue with our series on financial accounting. And the topic for today, we are going to continue from where we stopped last time. Last time we looked at the double entry or the golden rule. So we want also to continue with our double entry, but this time around we are going to pick a practical question so that we can be able to go through the double entry and be able to understand how we can be able to post transactions to their respective ledger accounts. That's what we are going to do from here. So we are looking at double entry. We are still looking at the double entry rule. And this is part 2. Because in the part 1 we explained what are the things that we are supposed to know. We looked at the different rules under different accounts. So the double entry rule, and this is our video number 2 on the double entries. So as I said, we are going to look at a simulation and we'll be able to see how we can be able to post the different business transactions as we may come across them in different past papers. So this is going to be something that is very basic, just to help us understand how we can be able to post the different entries in the different ledger accounts on the different accounts that we looked at. Because we saw in the previous video, we talked about the accounts that we have, where we looked at the personal accounts and then the impersonal accounts. We looked at within the impersonal accounts, we had two things. We had things to do with the real accounts and then the nominal accounts. Then the personal accounts, of course, those are the debtors and the creditors accounts. So that's what we are basically going to look at. So without wasting more time, let's dive in and look at the simulation of what we are going to learn today. So allow me to take off the video so that you can be able to concentrate on the screen. So we are looking at a simulation with these different business transactions that I want us to use to enhance our understanding of double entry rule. So the simulation, so we can have something to do with maybe June 1st. This is our transactions. Started a business with cash of 10 million shillings, 10 million. That is our first transaction. The second transaction happened on June 2nd. Opened the business account, the business bank account with shillings 6 million. Then the third transaction happened on June 4th. On 4th, bought goods on the 4th, bought goods on credit from Mark at shillings 1.5. Then on June 6th, bought goods by check, at shillings 1 million. Then on June 8th, sold goods for cash to Tony at shillings 800,000. Then on June 11th, paid rent by check 500,000, shillings 500,000. Then on June 14th, returned goods worth 300,000 to Mark. Then on June 16th, the owner took 100,000 of cash for private use. The owner took shillings 100,000 of cash for personal use. Then the last one, maybe you can look at only those. We paid Mark his account. We paid Mark his account in full, less 10% discount. 10% cash discount. So let's now look at the solution. That's the question that we have. So those are some of the transactions that we are seeing, and we want to look at how best can we able to solve this question and be able to post in the respective accounts. Now, this is a sole trader's business. It's an example of a sole trader business, and the person started the business, and we are going to look at the different transactions that occurred day by day. We start by looking at what happened on June 1st, because they told us on June 1st they started business with cash of 10 million. So we want to understand what this means. Now, so the first transaction, if I may write it here, started a business with cash of shillings 10 million. Meaning this is the money the person started business with. Now, this transaction means that the business started operations from 1st June. And then it started that business with a cash of 10 million. Now, I told you that whenever there is any transaction, then we are supposed to open what we call the ledger accounts for all the transactions that happened. And these transactions, we said that they are supposed to be monetary in nature. And as you've seen, all the transactions have been assigned a given monetary value. So whenever there is a transaction, just like what we are having here, started a business with cash of 10 million, the first thing you have to do is to first identify the two accounts that you are going to open for every transaction. Because I told you that double entry recording means that the transactions will affect each other twice. So there is always what we call the double effect of each transaction. In other words, each transaction is going to affect the two entities twice. There is always a double effect. And thus we are going to look at for those two accounts where we are going to see their double effect. So it means for every transaction that you see, every business transaction, one, it's supposed to be monetary in nature. Two, it is a must, you are supposed to identify two accounts that you are going to open. And why is it so? Is because of the double effect of the double entry recording or double entry system. And the next thing that you are going to do is find out whether we are going to be debiting a given account. We find out which account are we going to be debiting and which account are we going to be crediting. So first, you've seen a transaction, and this transaction should be monetary in nature. Two, you identify two accounts in each of the transactions. Three, you look at which account are we going to debit and which account are we going to credit. So you are supposed to know which accounts are we going to credit and which one are we going to debit, because we are sure that for every debit entry, we must have a corresponding credit entry. And that's why we ask ourselves, which accounts are we going to debit and which account are we going to be crediting. So once you have known those ones, then you go ahead and do so, you apply. So we've seen the first transaction, started business with cash of 10 million. Now, what are the two accounts that are involved in these transactions? And obviously, there is one, we have the cash account. That's an obvious. The cash account is there. Now, whenever you say transaction that is saying started a business, then just know the only thing that will come to your mind is going to be the capital. Because once you start a business, the money you inject in at the start of the business, we know that is the capital you are starting with. So whenever they say started business in any transaction, it means that they have introduced in capital. So the two accounts that are involved in such a transaction, we have identified the cash account from here. Then the second one, we have known that we have, this is the first, then the second is the capital, the capital account. So the two accounts are capital account and the cash account. However, sometimes you will not be able to see this kind of thing, cash, and they will just started a business with 10 million. And whenever they say started a business with 10 million, definitely that is going to be cash, except when the examiner is telling you specifically that 10 million was put in the bank account directly. Then it can be capital account and then the bank account. But if it doesn't specify, then it's supposed to be cash account and then the capital account, because we assume the money you are going to start a business with, you must have it at hand first before you transfer it to the bank. You are supposed to first have it. So what we are going to do is we are going to open two accounts, the capital accounts and the other account is the cash account. So let's open the two accounts. I'm just going to make them small as possible so that we can be able to incorporate in all these transactions. I'm just going to show you how they are supposed to be done independently. Then at the end of it all, we shall see how we can combine them with other accounts, because I want you to first understand the concept. So we have opened our cash account and the capital account. And once we have opened these accounts, then we show the currency sign. Now, these figures, they are in 10 million, but according to the space that we have, you can shorten them and maybe you work in thousands. We can put the currency side there, currency there. That's where most of the times we put our currency sign, our figures, and also the currency. You can also put shillings in thousands. You can also put shillings just to show the currency, shillings in thousands. The other, you can choose, this is the most preferred way, but if you see maybe the space, but I know you'll be writing somewhere, so the space will be enough. You can put it up here. You put shillings in thousands, but when you put it there, then it means it's going to be the most, as I said, the most preferred way is to put them inside that T account. But just for a matter of spacing, you can put it up there if at all you're just practicing. But for examination purposes, make sure you put them inside. So we show our accounts. This one is going to be our cash account. This is shillings. Then this is capital account. The name of the account is supposed to be on the top, on that bar. So you pick which one you are taking. So as I said, the other one is the most preferred. So we are going to go by what is in there. Now, we've put the currency signs and we have also eliminated the zeros. We are working in thousands. Now, we have a debit column and a credit column. We've said that the left hand side of the T account is what we call the debit side. So this one, we are going to call it the debit side. This is the credit side of each account. This is debit, this is credit. So we have identified those ones. In an exam, even if you don't put them there, but since we are doing it for the first time, I'm trying to put everything as possible. Now, the next question that we are going to ask ourselves after identifying the accounts that we have is which of these two accounts which one is supposed to be debited and which one is supposed to be credited. And looking at both of these accounts, we need to know which class of accounts are these and what's the rule. Remember, we looked at the classes and we also gave their rules in the previous video. But whenever there is a transaction that involves cash, then it is always advisable to look at it from the cash point of view or the cash side. So if you have seen that we have a cash account in a transaction, then you have to ask yourself whether is cash coming in or cash is moving out of the business. And that is going to inform you of the entry that you are going to be doing in the other account. So as long as you can identify one account and you know where it falls, then you will be able to know how you can be able to work around the other entry. Therefore, looking at the cash and the capital accounts, you will see that once you introduce in cash into the business, then it means that cash is going to be coming in. And remember, we said cash is a real account. Cash falls under the class of accounts of real accounts. So for real accounts, the rule is debit what's coming in and credit what's going out. So we've seen that cash is a real account. And once we introduce cash into the business, it means cash is coming in into our business. So once cash is coming in, then we are going to debit cash. And once you have debited cash, then automatically we are going to credit the other capital account. As long as you can identify one account and you know it very well, that this is a real account and its rules are these: debit what is coming in, credit what is going out. So what we are going to do is we are going to debit the cash account and then we credit the capital account. So as long as you can identify one account correctly, the other will be the opposite. Because once you have known what to do with one account, because we said for every debit entry, there must be a corresponding credit entry, and vice versa is also true. So, but what you need to know is that most of the times when there is introduction of capital, when you are introducing in capital into the business, if you look at it from the capital point of view, whenever we are introducing in capital, we always credit the capital account. And I will explain it why it's done in that perspective. But for now, we are looking at it from the cash point of view or from the cash account. And we concluded that cash is coming in and we shall debit cash with 10 million, but it will be in the names of capital as the narration that we are going to put in the corresponding account. So we come here, we put the date. If we had a year, if the year was available, we would say given that year, but they have just given us June 1st, we are putting in capital of 10 million. but we are working 1,000, so we are going to write 10,000. But according to my space, it's not enough. One thing I want you to learn is that whenever you are writing the dates within these accounts, they are supposed to be written in this format. You start with the year. This is the correct format that we are supposed to follow. You start with the year. Then you put the month, and then finally with the date, with the day. The reason as why we are taking it in this sense is that we always do accounting for annually for a given period. So it means most of the times, I'm not saying it doesn't change, but most of the times the year will remain fixed. So since the year is not going to be changing, it's better we start with writing the year, followed by the month. Even the month will not be changing most of the times. So if the month is not changing, we first put what is going to remain fixed, then the one which is nearly going to be fixed, which is the month, but the day of the month will keep on changing. So once they have given you a year, let's say we are writing in 2020, so it will be 2020 if it is we are doing it in June 1st, so that every time you are writing, you will be writing 2020 June 1st. But the next transaction which came, let's say the next transaction came on 2nd, you are not supposed to write all this and this. You just put 2nd. If the month changes and maybe that transaction happened on 1st, you just add just this. You just put June, but you don't write the year again because the year has already been written. So that's one way of saving time, not writing too much, but you are being organized. Remember, these accounts, we are supposed to be neat whenever we are filling in this information. So I hope you have got that. Now here we are just working in only 1 month. It's going to be June. You start with June 1st. When you are going to the next transaction, you're not supposed to write June again. You just put the date 2nd because you used a correct format. Now just imagine if at all you had started with first, then June. It means every time you are going to be writing a transaction, you are supposed to write it, all of it. You can't say you put 2 here and here you don't write. So the other side looks more professional. I hope that one helps. So this happened, can put it here, June 1st, then capital 10 million. Then I come to this side, I also put June up here, 1st, cash. It's going to be in the account of cash, 10 million. I'm writing 10,000 because I've already wrote the 3 zeros up. That's how we treat that first transaction. So whatever we've just done, we've made sure that we've recorded the cash, but we looked at it from the cash point of view. And I also explained how the dates are supposed to be handled. So that will be done. We shall look at how we close off the accounts. But since there are transactions going on, but as I said, I'm going to be handling transaction per transaction. I'm not going to combine all the transactions at once. No, I'm going to show you how you should handle each transaction. Then at the end of the day, I will show you how you can merge all the transaction and you have few accounts. So if you want to close off this account, you just close it off. You know the normal way we've been closing them off. I'm closing them off because we are dealing with one transaction at a time. We are not going to combine, even though the question is combined, but we are not going to combine them. I first want you to understand. So you put here the 10 million, that is going to be 10,000, even here 10,000 because this side is bigger, even here 10,000, even here you'll have the 10,000. So you bring your balance carried down. This one is going to be done at the end, 30th June. Balance carried down is going to be 10,000. We shall look at balancing of these accounts, and you also bring the balance brought down this side of 10,000. Even this one, balance carried down of 10,000. You bring the balance brought down of 10,000. So this will be the figure that will be taken to your trial balance. We shall look at those. Let's first finish filling in these transactions. So we look at number 2, the second transaction. Transaction 2. Second transaction says opened business bank account with 6 million. Opened business bank account with shilling 6 million. Now, opening a bank account means that some of the cash that we had started with will be transferred to the bank account that we have just opened. Because you know, when you're opening a bank account, it means you're supposed to keep their money. You don't just open the bank account and you just leave it like that. You may be required to deposit some money or to leave with some money, especially if it is a business account. And even opening itself requires some money. You incur some costs when you're opening these accounts. So they are saying opened business bank account with 6 million. Now, we are seeing that we have 2 accounts that are involved. We have the bank and we also have the cash, because this is the transaction that happened next. But at first we started the business with the 10 million. But now if they are telling us that they opened the business bank account with the 6 million, the issue is they are not introducing in more money, but they use the money they had already gotten in cash of 10 million and they put the 6 million in the bank account, meaning that the other side it is only remaining with 4 million. We shall do accounting equation and we'll do some of these practically to see how we can reduce this. But let's first understand how we can post these transactions into the different ledger accounts. Now, I have said that there are 2 accounts that are involved here, the bank account and then the cash. Even though cash is not mentioned in this transaction, but it is the cash that we started with. It's the cash that we started the business with that we are partly using to open up an account. Therefore, this is cash and bank as our 2 accounts. So the 2 accounts are cash account and bank account. So those are the 2 accounts Now, the next thing after identifying the two accounts, we need to know which class of accounts are they. Now, if we are doing if we are going to combine doing this question at once, we wouldn't open another cash account because the cash account was already opened at the start. But as I said, we are going to first understand how to deal with separate transaction. Each transaction, we are going to look at it individually. After we have understood that, then we can combine the question and then we extract a trial balance. I hope you are getting the reason as to why I'm saying so. So we are going to open two accounts here, the cash account and the bank account. But I'm repeating that if at all we are doing this question as a one question, we wouldn't open another cash account because the cash account was already opened in part one, or in the first transaction we opened it. So since we are doing it independently, we open two accounts. We have the cash account and then the bank account. We put the currency. You're working in thousands. You can also put shillings in thousands, but according to the space is small, so that's why I'm putting only this. So this question we are doing is requiring us to open two accounts. One of the account was already opened, but we said that we are opening these financial transactions independently. We are first dealing with them independently. So that's why we opened two accounts. Now, after that, we need to know which one of these two accounts is going to be debited and which one is supposed to be credited. And we know that cash account, since there is cash, we said it is a real account, and also bank account is also a real account because one, cash can be in two ways, can be cash at hand or cash at bank. So both of these are cash account, they are real accounts or accounts that are relating to tangible things or tangible properties. And we said properties, we don't necessarily mean assets. So you go to the previous video and you watch this to be able to understand this. So we are now making the application of the rules that we created. Therefore, from here, we need to ask ourselves, which of these two accounts is going to be giving out and which one is going to be getting. So from here, we are saying that one of the account is getting money and then the other is giving out money. One is getting cash, then the other is giving out cash, since they are all real accounts. Now, once we are talking about cash moving in, we are transferring cash that we have to the bank. It's like we are banking cash. It means that cash is going to come into the bank account. And by the rule of real accounts, we say that we debit what is coming in and then we credit what is going out. So this transaction happened on 2nd. So since the bank account, we are receiving money, we are going to debit it. So it's going to be June 2nd. Let me use a different color so that we can be able to isolate. So let me just put here June 2nd, we are receiving cash. As I said, for you, write it the whole. You start June 2nd, then you put cash. But since I don't have space, I'm just going to write, I'm going to ignore the dates. So here I'll put the cash of 66 million. So since I've taken the other 3 zeros up, I'm going to write 6,000. So once you have debited one account, then it means there must be a corresponding entry on the other account. So since this is a debit, we are going to credit this cash account in the name of bank. The name of bank with the same amount. So that's what we are supposed to do in that account. So on June 2nd, we debited the bank account in the name of cash of 6 million, and when we went to the credit side of the cash account, we credited it with the same amount on the same date. So you are seeing that this account here, the account I have here, corresponds with where the transaction is coming from. Even when I look at this, it shows me where the transaction is coming from. It is coming from here. I hope you can be able to recognize that. So that is going to be done, and that's what we call the double entry. As long as you know one side, then the other is going to be the corresponding entry. But we can't have a debit and a debit. That can't happen. So that's what we are supposed to do. Then you close off this account. Because I said we are closing each account individually. You know the rules of closing accounts. You look at which side is bigger. This side is bigger, 6,000. Then here is going to be the balance carried down of the same amount, 6 million. Then also this one, the total is going to be the same 6 million. So here we bring our balance brought down of 6 million. We do the same thing here. Even this one is 6 million. The total 6 million. Then the balance carried down. Balance carried down is going to be 6,000. Then the balance brought down will be 6 million, 6,000. So this figure is the one that we shall take to our trial balance. This one, the brought downs, they are the ones we take them in their respective sides. When you are taking these values to the trial balance, we don't consider the double entry. We don't do a double entry that what is on the debit side you put it on the credit. No, you take it the way it is. If this is the cash account, if this is bank account and it has a debit balance, you take it as a debit balance. If this is a cash account and it has a credit balance, you take it, the brought down is on the credit side, you take it on the credit side. So that's how we are going to be doing some of these things. But remember I said we are separating these transactions individually. If it was mixing the other transactions, this cash account wouldn't appear again. We would only open the bank account. Then we would have taken this account to the other side where we had already opened. But since I said we are working transaction per transaction, then that will be done. Let's look at transaction number 3. The next transaction happened on June 4th. On June 4th, and they told us they bought goods on credit. Goods on credit. Goods on credit from Mark. From Mark at shillings 1.5. 1.5. So we need to goods on credit from Mark. So we need to see how we can handle that. Now, the two accounts that are involved here we have, because it's the goods that they are buying, and we said when they are buying goods for the purposes of resale, they are called purchases. So the first account is going to be purchases account, and then the other account, because I told you that purchases are for goods that are bought for the purposes of resale, meaning they are purchasing stock, and that's why we are saying we have the purchases accounts. 2, we shall also open markers account. You have to note that we are only opening markers account because it's on a credit. It's a credit, say a credit purchase. So since it is a credit transaction, then we open markers account, and the marker is a human being. But if it was a cash transaction, then we wouldn't have opened a purchases account and a cash account. Of course, we wouldn't open markers account if at all they had paid him by cash. But since these were bought on credit, because we said you can't open a personal account if at all the person you sold to paid cash, or you bought goods and you paid cash. We don't open personal accounts, but we open cash accounts, and then we represent the purchases. I hope you remember those principles that we spoke in the previous videos. So if it was cash transaction, markers account wouldn't appear anywhere, wouldn't appear in our accounts. But since it is a credit, then we are supposed to open that as markers account. So the second account is going to be markers account. And these symbols are actually recognized. This one, call it account. These they are recognized. You can also use them, they have no problem than writing the whole word. So let's be mindful that the only time we open a personal account is when the transaction is on credit. And that's why I say that personal accounts are accounts of debtors and creditors alone. So once you don't have those, then it means you are not going to be opening a personal account. And not forgetting that we say the person can be an individual, can be a corporation. So since it is on credit, we are going to open markers account. So let's open the two accounts. So we can call this markers account, marker account. Then this is purchases. Then you put the currency sign. Can put in thousands. We are working thousands because we don't have space. So, and what we are going to do, or what we do next, is to find out which accounts are going to be debited and which accounts are going to be credited. So, looking at this transaction where they are buying goods on credit from Mark, so we need to know, we need to see, or we need to know which account are we going to be debiting and which account are we going to be crediting. Now, Mark is a personal account, and we said that the rules for personal accounts, we say that once you are able to apply the rule on any account, then automatically the corresponding entry is supposed to be on the other side. And I said there is no way you are going to get a debit entry on one account, then you also get another debit entry on the other account. So that's why, since we have identified Mark as a personal accounts, then we need to know what are the rules of personal accounts. But we should always avoid double debits or double credits, that I credit Mark at the same time I credit purchases. Doesn't make sense. or I debit mark, at the same time I debit purchases. That's not a double entry rule. The rule is you debit this account, then you must have another account that is going to be credited. Once the other account is credited, then you must be having another account that is going to be debited. That's the rule, and that's what we are applying here. So since we have identified one, that we are buying goods on credit from Mark, then we have to ask ourselves whether Mark is going to be receiving goods or is going to be losing out the goods. Is Mark giving? Because we have identified Mark as a personal account, and the rules for personal accounts are you are going to look at which side is receiving and which side is giving. So the rule for personal accounts, we debit the receiver and then we credit the giver. And in this case, Mark is giving out the goods. And we, the business, we are receiving the goods. And because Mark is giving the goods out on credit, then Mark is going to be credited because he's the one giving out. We are going to debit ourselves, then we credit Mark's account. So the same date. So we are going to credit Mark as of June 6th in the names of purchases because it's the corresponding account and the amount is 1.5. And when we come to the purchases account, because we have the purchases in the Mark's account, then automatically we are going to debit purchases account as the corresponding entry. So let's see. Let's fill in the values. So we are going to credit Mark's account in the name of purchases. Make sure you put the dates. It is 1.5, but I'm taking 1,500. So we are going to come and debit purchases in the name of Mark 1.5. So the reason that's why we are taking here Mark is because it is where the information came from. And the reason why we are putting purchases here is because that information is coming from the purchases account. The other way is to look at the purchase account and you try to know what a purchase is. You know, when you are purchasing, you are buying. And once you are buying, it means you are spending money. It's like an expense. So, because it's like an expense account, we are going to debit it. Because we said that we always debit all expenses and losses. That is for nominal accounts. Purchases are falling under nominal accounts. And we said with the rule for nominal accounts, we debit all purchases, we debit all expenses and losses, and then we credit incomes and gains. And that's why we are debiting the purchases account, but on the same date, and it will be in the names of Mark with the same amount of 1.5. So that's what we do in that. So we can close off this account too. So this side is bigger, so we take the 1.5 to be the total for both. 1.5. So this is going to be the balance carried down of 1.5. Then here will be the balance brought down of 1.5. So we also close off this. It is the same 1.5 as their total for both sides. Then balance carried down of 1.5 it will be the brought down this side, the opposite side, balance brought down of 1.5. So when you are taking it the 12 balance, we pick only this balance. We pick the balance brought down this side. So for markers account, we shall take the 1.5 on the credit side. For purchases account, we shall take the 1.5 on the debit side. So that's how we do those. So let's go to the fourth transaction. So transaction number 4. So the next transaction, they bought goods by check of 1 million. They bought goods by check of 1 million. 1 million shillings. So once they bought goods on credit, so they bought and they paid by check, meaning they paid by bank. Now, we need to know what are the two accounts that are involved in here in this transaction. And we are now seeing that we bought goods. And when you buy goods, those are purchases. So the first account is purchases account. We are buying goods. And the other account is going to be bank because we are paying by check. So anytime you see check, then it's the bank account, because it is going to be the bank account that is going to be affected, because a check is going to be withdrawn from our bank account. Therefore, once you are buying or once you are paying by check, then it's automatically affecting your bank account. Now, we need also to ask ourselves, which of these two accounts are we going to be debiting and which are we going to be crediting? But remember, we had already opened a bank account and we had already opened a purchases account. If at all we are doing this number as a one entry, this transaction wouldn't be opened before. Wouldn't have any account opened, because we had already opened them in the previous transaction. We would just post those values. I hope you are getting that argument, but we shall understand and we shall learn how we can be able to do this. But let's first understand what are the things that we are supposed to do. So we say the purchases account is an expense account. And the rule for expenses is that we debit all expenses and losses. And obviously, we are going to be debiting the purchases account. And once we have debited the purchases account, then automatically we are going to be crediting our bank account. On the other hand, you can look at it from the point of the bank. You look at from the banker's account, and you see, we know that a bank account is a real account. And the rule for real account is that you are going to look at whether cash is coming in or cash is going out. And that's the rule for real accounts. So the rule changes. The rule will be changing from that of an expense. And once cash is moving out of the bank account, then we shall credit the banker's account in the names of purchases with the same amount. So either way, you have been able to understand it. If you understand it from the bank, the bank side, then it will be fine. As long as you can understand one transaction, the rest will be the opposite, will be on the opposite side of the other. So let's open the two accounts. So this one is going to be, let's call this one the bank account, and this one the purchases account. So put the currency sign We are working in thousands. So they have told us they bought goods by check 1 million. They are worth 1 million. So we've said that purchases are expenses, and we said expenses, we debit all the expenses. That's for the nominal, the class of nominal accounts. So we are going to come here and we debit, but it's going to be in the names of bank. So bank 1 million. We are writing 1,000. Then you come here. The corresponding entry is supposed to be on the. Sorry. This is supposed to be on this side of the purchases. Bank 1,000. Then you come here on the bank account. You put purchases. So you see, you can actually make mistakes. So you just need to follow the rules. You see, if you want to go by the banker's account, we know that as we buy goods, we are losing money. Money is moving out of the business. It's moving out of our bank account. And that means if money is moving out, then we are supposed to credit that account, because that's the rule for real accounts. So that's going to be done for that. So what we are going to do, we close off. So we close off this. This is going to be 1,000. Even here is 1,000. Then the balance carried down of 1,000. Then it will be the balance brought down of 1,000. We also close off this. This is 1,000 because it is the biggest part. 1,000. Then the balance brought down, balance carried down of 1,000. Balance brought down will be this side. Balance brought down of 1,000. But at some point, since these two accounts are the same, we had already opened these accounts, you'll find that some of these accounts will disappear because you may purchase and you offset. You'll find that some accounts will have no balance carried down. So we shall look at when we do a combined approach. So let's look at the next transaction. So the next transaction is all about, number 5 is all about, they are saying they sold goods for cash, and the amount is 800,000. Sold goods for cash and the amount is, so we need to identify two accounts. Now the two accounts that we are going to have here, once it is goods that we are selling, then it means we are going to be having sales account, and then the other account, they are telling us that sales, they have made sales of 800,000, but we received the cash, so it is going to be cash account, and then the bank, the sales account, and then the cash account, because we are receiving money in cash. So because remember we said the sales, those are disposal of stock, but since this is not a credit sale, then we are not supposed to open for the other person. The other person we sold it to, because he paid us. We can't open a personal account because the other person paid us. So that's why we are opening a cash account and then the sales account. So I told you, even if they attach a name of the person whom they sold it to, but we still open a cash account, even if they put that we sold goods worth 10 million to James. James's account is not supposed to be opened as long as the payment was made. We only do that if at all we are selling on credit. As long as cash has been received, we don't need the person's account. So the two accounts are those. So we open the two accounts. So this is the sales account and then the cash account. So now we are going to identify. We know that cash, you can look at the cash. The cash is a real account. So we need to see, is cash coming in or cash moving out? And for cash, we can see that actually cash is coming in because we are selling goods. So what we are going to do, since cash is a real account, we are going to, the rule for real account is that if you debit the receiver, then you credit the giver. So here we are receiving cash. So we are going to be debiting it. So we come here and we debit it, sales of 800. Then, of course, automatically the credit side of the sales account will be done in the names of cash. Cash 800,000. But not forgetting to put the currency sign. So don't forget to put the currency. So we close off this account. So this is going to be 800. Even here it is 800. So the balance carried down will be 800. Then balance brought down here will be 800. Also this one is 800. Even here the total 800. Balance carried down will be 800. Then the balance brought down this side will be 800. And that's what we do for that account. So we know sales money will be coming in, and that will be a nominal account. So when money is coming in, we credit the account, if you want to look at it from the sales perspective. So looking at the next transaction that happened on June 11th, where we paid rent by check. We paid the rent by check 500,000. So paid rent by check. $500,000. So we need to identify which two accounts that are available. And what I said that once you see check, then you just know we are referring to the bank account. So the two accounts, we have one bank account, and then the other is the rent account. So the rent account and the bank account, those are the two accounts that we have. So we can now open the rent account and the bank account. But since we already know the other bank account, we've been opening the bank accounts. But as I told you, we are handling transaction per transaction. If at all we are not handling transaction per transaction, we wouldn't open another bank account. So we open bank account, then the rent bank account, and then the rent account. Now we know that if you look at it from the banker's side, we need to see which one are we going to be debiting and which one are we going to credit. So if you look at it from the banker's side, we know bank account is a real account, and obviously we need to know whether cash is coming in or cash is moving out. And when you are paying rent, it means cash is moving out. So in that perspective, we can see that our bank account is giving out or is losing money. Money in the bank account is going to be reducing or decreasing. And since it is going to be decreasing, we credit it. But also when you look at the rent, rent is an expense. And we say the rule for nominal accounts is that we debit all expenses and losses, then we credit incomes. So whichever way you go, as long as you can tell that this account is belonging to this class of account, it will be good to go. So we put in the currency. So either way you take, so we know that this is an expense account. So we debit all expenses in the name of bank. So we shall come here, we say bank 500,000. That's the money we are paying out. So this is bank 500,000. So once you have identified one entry, then the other one in the corresponding side is supposed to be on the opposite side. So we come here, we say rent, in the name of rent, 500,000. So that's it. Then we close off the accounts. So this is going to be 500. Even this side is 500. This is 500 also. Even this one is 500. So balance carried down is 500 this side. Then the balance brought down will also be 500. Then also this is the balance carried down of 500. Then balance brought down of 500. And that will be that will be done. So we look at the other transaction. The other transaction, they said returned goods worth 300,000 to Mark. Returned goods of 300,000 to Mark. Remember, Mark is our person who supplied to us goods on credit. Is our supplier. So there is a return. Now, we know that Mark is our supplier or is our creditor to the business because he is the one who sold to us goods on credit. We bought goods from Mark on credit. And that was, the goods we bought were worth 1.5 million. And we returned, they are saying that we returned goods worth 300,000 to Mark. Now, what we need here, we need to find the two accounts that are involved here. And Mark's account is obviously one of them. And then we can have the goods returned to Mark. Of course, the goods returned to Mark is actually the return outwards, because these are returns on purchases. We are returning goods to suppliers. That is a return outward. If it was customer returning it to us, then it would have been return inwards. So this is a return outward because it is the business returning goods to the supplier, since Mark is our supplier. And return outwards is the same as the purchases return. So we'll open both accounts for Mark's account and then the purchases return account. But if at all we are doing this for the entire question, Mark's account, we had already opened it, we wouldn't open it again. We would just post the transaction there. So we have Mark's account and then the purchases return account. So we are going to open two accounts. So since I said we are doing it separately, let's open both accounts: purchases, return account, then markers account. Marker is our creditor, or is our supplier. So put in the currency sign. So we can now put in the figures. Now, the next question we shall ask ourselves is whether these accounts are going to be, which of these accounts is going to be debited and which one is going to be credited. But one thing, you can look at it from the markers side. Markers account is a personal account. And we said, since we are returning goods to mark, and the rules for personal accounts are you debit the receiver, then you credit the giver. And from this case, mark is receiving goods. And once we are receiving, then we are going to be debited. So we shall debit markers account, then we credit the return outwards, or the purchases return. And that's basically what happens with the purchases return. Remember, we said purchases, they are from the other side in the perspective of expenses. But now, these ones are returns. It's like we had paid some money, but they are bringing back the money. In other words, we had made an expense, but now we are cancelling the expense. How are we cancelling? We had bought goods of 1.5 on credit, and the supplier was demanding us 1.5. But what happens with the return is that we returned some of the goods, and we are not going to pay for those goods that we have returned. So it's like a cancelled expense. So if the expense was debited previously, then this one is supposed to be credited to reduce on the other figure that we were supposed to pay. I hope you are getting this kind of argument. So there are so many ways you can access some of these things. Others, you can actually access some of these things by understanding the accounting equation. I will address more when we do the accounting equation. I know we illustrated how it comes about, but we haven't done any practical simulation to help us understand more. But when we do that, I will help you, because we can understand that this mark is our creditor. We know that liabilities always have a credit balance, and when the liabilities are reducing, we debit by reducing the liability. So we shall understand some of those things as we progress. So we are returning some of the goods. Now what we are going to do, you don't forget the debts. So Mark was demanding us more, so we are reducing some of them. So we can call this return outward, RO, to mean return outward, or purchase return of 300,000. Then of course we come and debit the purchases return. This is from the markers account. So we can balance this off. The total this side is going to be 300. This is the balance carried down of 300. Then this will be the balance brought down of 300,000. So this is 300, even here 300. This is balance carried down of 300,000. Balance brought down of 300. I hope we are able to pick some of these arguments. So let's look at the next transaction. Transaction number 8, which happened on June 16th. They are saying that the owner took 100,000 cash for personal use. The owner took 100,000 cash. The owner took 100,000 of cash for personal use. So the same thing that we are going to do here, we want to identify the two accounts. They are saying that the owner of the business took 100,000 for personal use, 100,000 cash for personal use. And I told you that whenever the owner of the business takes cash for personal use, then we call that drawings. So the two accounts that are involved, we have the drawings account and then the cash accounts. So we need to open accounts for cash account and then the drawings account. If at all we are doing this question at once, since we've been opening cash account, we open one cash account, then you put all transactions that are related to cash. So this one we will just open the drawings account. But as I said, we are only looking at each of these statements independently. That's why we are going to open two accounts, the cash account and then the drawings account. So we have drawings account and then the cash account. So we draw them. So this is cash account, this is drawings account. Now we know that cash is a real account, and we need to know whether cash is moving out or cash is coming in or is moving out. So the question will always remain the same. So the two accounts involved, we have seen them. Then what you have to see is, or what you have to ask yourself is, which accounts should be credited and which accounts should be debited. So if you look at it from the cash point of view or from the cash aspect, then you can ask yourself whether cash is coming in or cash is going out. But here, the person or the owner is picking out cash, and then it means that cash is actually going out of the business. And the rule for real accounts, we always credit what is going out and we debit what is coming in. Therefore, once you are able to identify that this is actually a real account, a personal account, or a nominal account, the class, then you can be able to do what we are doing here now. So the drawings accounts are supposed to be debited in the names of cash. And remember, the drawings accounts, these are private accounts. They are private accounts. We looked at what private accounts are. They are the ones that are private to the owner. So we put the currency. So cash is moving out, so we credit cash in the names of drawings. They are taking 100,000, so we shall write 100. So we are coming to debit the drawings account in the name of cash, 100. Then we close off the accounts. So the total is 100, even here 100. So balance carried down is 100, and then balance brought down is 100. Then we also close off this. So this is also 100, balance carried down is 100, then balance brought down this side is also 100. And that's what we do with the drawings account. So we now look at, I think, the last transaction, which is transaction number 9. Transaction number 9. They are telling us that we paid Marker's account. We paid Marker's account in full. Paid Marker's account in full. Marker's account in full after deducting a 10% cash discount. Now, here we have a concept of discounts coming in. And they are saying that we paid Marker's account in full, less 10% cash discount. And over here, there is no amounts that they have mentioned. So we have to get the amounts that we are going to use. And we can only get those amounts after drawing the Marker's account. Meaning we shall look at the Marker's account and we know the amounts that we are looking at. Remember, Mark is the person who supplied us goods initially we bought goods on credit from Mark of 1.5, meaning that Mark is actually demanding us 1.5 as of that date when we purchased. And then we also returned to him goods worth 300,000 out of the other 1.5, meaning that the difference of 1.2, because he supplied to us, the cost was 1.5 at first. Now, we had a discount. We had a return. We returned some goods. Returns, it was 300,000. So that gives you 1.2 that we are demanding. But now they are telling us we paid this person in full. This is the full amount that is demanding us. But on top of paying him in full, he gave us a discount. He gave us a 10% discount. So a 10% discount will be 10% times the 1.2, because this is the money we are supposed to pay him. That will give you 120,000. So meaning the discount alone that we received from Mark, because Mark is our supplier, we received this. Remember, we are supposed to pay him 1.2. Meaning, if he gave us a discount of 10%, which is 120, we must have paid this 101.2 minus the 120. That is the money that we paid to him. So it was 1,080,000. So this is the money that we paid him after deducting. So we paid all of this to him in full. So the discount of 10%, we deducted it and we remained with that. So you have to be careful. We are supposed to pay 120, but because we received a cash discount of 10%, then we are supposed to deduct that 10%, which is giving us 120,000, which is our discount received. So when we take it out, we pay him 1,080,000, and that's the amount that we gave to Mark in cash. Since it was a cash discount, it means we must have paid him with the cash. That is the assumption. But even if you deduct it from the bank, maybe if it's not there, but if it is there, you can also deduct it from the bank account. But it is more preferred if you deduct it from cash, because by him giving us the discount, we must have paid on time, or we must have paid money promptly within the time frame that we had estimated. So now I want you to listen very, very carefully on what we are going to do, because this is the math that we did. So we have now two accounts. We have cash account and then the markers account. We need to know which accounts are we going to be debiting and which one are we going to be crediting. And of course, cash is actually going out because we are using our cash to pay off this mark. So cash is going out. But the only amount that is going to move out is only 1,080,000. So we shall credit cash account with that same exact amount of 1,080,000 of cash that we are going to use to pay mark, because that's the actual amount of cash that we are losing in the payment of our supplier. But we came to when we come to the corresponding entry, remember we are going to have cash account is going to be credited by 108. So once we come to the corresponding entry or the corresponding side, that is the debit side of the markers account, because markers account had a liability. There is a liability was demanding us this 1.2, meaning markers account is still reflecting this figure, because remember we deducted the returns. The cost was this, we deducted the return, we remained with this. So meaning in his account we are still demanding 1.2. Now what is going to happen is that we are going to take off, remember we have just taken off this 1,080,000, meaning there is this difference. This one we are supposed to open a third account for discount received. If it was a customer, it would have been a discount allowed. So we shall learn about those discount received and discount allowed under the cash budget as we are going to see. But just know we are going to create a third account for discount received. The reason as why we are creating it is in the sense that, remember, we had a credit balance of this of 1.2 and we debited it with this, meaning this balance is not offsetting it, and they told us they paid in full, meaning the markers account must disappear. The only way it's going to disappear is by debiting it with the discount received of 120. It will be balancing, because when you add this plus this, it will give you this. That will sort the mismatch. And that's basically what we are going to do. But remember, discounts are going to be credited, because the discount received is an income. It's like they have forgiven you to pay some amount, otherwise you would have paid it. So it comes as an income to us because of the amount that we've received. So let's go into the posting. So sometimes you may find yourself having to decide on certain things. So we have said we are going to have, then the third one, maybe we shall have this is as a discount received. Discount received, this is the cash account. Then this one is going to be the markers account. We show the currency signs. So we said we are going to be debiting marker's account by cash, the money we paid, which was cash of 108. So we come here, credit, cash is moving out, we credit. It has gone out into marker's account. That's why we are putting the name of Mark 108. Then remember this one had already balance, so we shall also bring in the discount received here. Discount received over 120. So we shall take it this side as June. We give its date 19th. It is coming from the marker's account as 120. So that's how we write all the entries. So once you are done with that, then we close off the accounts. Remember this one. Here we had, remember we had some returns. We shall look at, we shall see. So this one is going to be 1.2, the total. 1.2, and it's also going to be the total for this 1.2. So balance carried down of 1.2. So this one is going to be June 30th, balance carried down of 120. So we close off that 120. Even this one is 120. So we come to the other month, July 1st, balance brought down over 120. Then we also close off this. Of course, this one is going to have a balance brought down here. Balance brought down is going to be 120 here. So we can close off this as well. Then we shall have 108. This is balance carried down 108, 0. 108 as the total, then balance brought down 108. And that's how we are supposed to do those accounts individually. But now what we are going to look at in the next video, we are going to summarize all these in one document, whereby we are going to have a page of these different ledgers. And after that, we shall be able to extract the balance sheet. But I told you, these balances that we have here, they are the ones that you take to the balance sheet. And we shall see, sorry, not the balance sheet, the trial balance. And we shall see from there. So this is the end of part 2 of this double entry. So we are going to look at part 3, where we are going to take the same question, but we make sure that we get all these accounts drawn at once, we balance them off, then we extract the trial balance at the end. So thank you for watching.